Hey guys.
Hey.
Hey, we're all Royce decided to be at the bottom of the screen, so we decided we would be too.
One
Josh looks like
team,
he's
one
trying to.
dream.
That's right.
My
one
chair doesn't
team.
recline.
Josh looks like he's trying to dodge something.
We're doing that because the market went down and now it's going back up. So now we're going to go back up. Oh, here we go. All right. Royce is going to stay down there somewhere.
Nope, I'm staying.
He looks like you really look like you got a really small head.
I like it.
You like
I'm
it?
going to bring a plant to come and get you, and we're going to go from there.
All right. Well, we'll go ahead and just start, even with him back there in the distance.
From this moment on.
From this moment. Oh, I better not be singing. Yeah, I know. It's been a rough week.
Please don't.
All right, here we go.
Solo, we can't hear you.
At least I have an excuse this week, though. So anyway, this is After the Bell. It is Wednesday. It was NVIDIA and FOMC meeting notes day, I think, or something like that, or jawboning, whatever they do over there at the Fed, as long as we have them still. I'm Darin, with Arbitrage Trade, and this is After the Bell. So my guests are Daniel Hopwood, that's top right. On your screen, we've got Josh Morgan, the bankster, down at the bottom left. And the bankster is between a gangster and a banker. So
I'll take it.
Got that clear. And then down at the bottom right.
That up.
Yeah. And then the bottom right, we've got our fearless leader, Royce Wells, our CEO and creator of Pips, the magical machine that we have that can predict things better than others. So disclosure, though, I got to get that out of the way. We are not financial advisors, even though we do have Pips. And this is not financial advice. This information provided is surely for educational purposes and entertainment purposes, possibly. Please always consult an investment professional before making any financial decisions. So I've got the numbers just in case we had some lag time between Singapore and here. Dow Jones was up plus 0.1. We could call it flat, but it was at 46,138. We got S&P 500 plus 0.38 at 6642. We have NASDAQ at plus 0.59 at 22,564. We have the dollar right at the 100 mark, 100.06. Yep. We have crude that's still under $60. We have gold at 40.81 as it starts to creep back up again. It's up plus 0.38. Silver's at 51.12. It's ascending quicker at 1.19. We've got the 10-year at 4.14, which actually has gone up quite a bit. And we've got the Bitcoin that did drop down below 90, but now it's at 90.5. But that's still down for the day, 2.12. We have Ethereum at 29.89, just under 3,000 and that was a negative 3.52. And we have XRP at 2.08, which took a big hit at down 5.39%. So that gets you caught up on the numbers. And then you also mentioned the VIX. What's VIXy doing? I guess it kind of probably cooled off today, right? I haven't looked at it. Is it under 20?
Yeah, it's trading down to 23 spots.
Yeah, 23.
Oh, still 23. Okay. All right.
Yeah.
Might take a couple of days to go. Yeah. Anything else you want to add to that before we move on to the headlines, Daniel?
No, I just think I didn't expect the market to get this weak looking. I honestly thought it would hit the 50-day, hit some arbitrage supports and bounce. But even, looking at the futures right now, it kind of whipped up and hit the 50-day as resistance and kind of sold off from that initial point. But now that NVIDIA has reported they're up I think 6% after hours or something, 5.5%. And they're a pretty big pull in the market. But even if you look at the Mag 7 after hours, it's still, even with the post-market pop from NVIDIA, it's still pretty weak looking. So, and to be clear, I'm still not calling for any kind of crash, but I am surprised about how much it's correcting. I definitely thought this was another 3% dip, and everybody in retail buys it and rips to the upside.
So what isn't the volume down? right now. I think everybody was waiting to do anything after the FOMC did their statements, and then so now you had the Nvidia after market. So it's, to me, it'll be like what happens tomorrow and Friday with options that are already put into play. So it'll be fun to see what happens between now and Friday close.
I think option expiry is next Friday, right? So it could also kind of be pinning the market to where it is, but
Right. Anything else that we should talk about as far as the markets go? You guys were saying, I think Royce was asking the question, do you think it's going to go up or down?
Yeah.
I'll have to.
Yeah.
I'm flipping.
Where you want to weigh in?
I would flip a coin, literally, right now. I don't know if I have any coins around here.
Let's do better. Josh can do better than that, right? Josh, you can do better than that.
I haven't looked at the chart in a minute, but let me see. Let's see. What are we looking at?
All right, so chock full of excuses.
While he's looking at that, you said it's hit the 50-day, right? It's right. That's the marker now. And then how far down was it? What percent does it have to go to get to the 200 again?
Another 5%.
Exactly. So
5.25 from where it is.
Yeah. So I can think that's the question.
We're gonna get some more up and to the right.
Josh says up and to the right. More bulls
from
left.
At least from
short
this point immediately, or
at least for the next couple weeks. I wouldn't put it too much further than that. Again, if you zoom out and look at like arbitrage bands on the daily, they were flashing some pretty bad signals at the end of October, 1st of November. So we're seeing a little bit of a cool off. I just don't know if we really satisfied that enough to say that those indicators have been met, but at least we'll get a little bit of temporary relief, I think.
You guys remember it was what was it Daniel said that history always shows that blah blah blah. Usually October is you remember when I said that? And then I said no, all right, then it's going to happen in November, because you always says it goes up in November. So we still have a chance to correct that in 2 weeks, but I'm just saying I might be right on that it just flipped. Everything was in November instead of October. But what do you say, Daniel? Up, down?
History doesn't repeat itself, it often rhymes.
Yeah. But your prediction, up, down, or flat?
My prediction?
Yes.
I think it'll, maybe muddle under the 50-day for a day or two and probably have another leg down, and then it's back up.
Okay. Which means the last week of
November. I just see, as long as it doesn't do more than 10% total, it's just a correction, right? And I think this could be get everybody real scared, 10%, like, oh, has the AI bubble popped? And then, it doesn't, and people kind of once again get left behind like they did in April. I mean, I'll be frank, I missed the April spring back, right? So.
Well, the AI bubble is the big topic. Now it's becoming, okay, since there might be some truth to that, is what's being said out there, that now everyone's focusing on the data centers and what that's going to do. So we'll see. I mean, they're moving from one subject to the other. It's funny how much we had talked about the circular motion over the last couple of months of NVIDIA and OpenAI and everything else. And then after that, we saw all these deals that were made that prove that. Here's NVIDIA says, hey, I'm going to buy this from you, and then you're going to buy this from me. And that was proven. And now finally the media jumps on board and says, yeah, the circular motion they're even saying that word of circular motion. It's almost like they were listening to our broadcast. But anyway, never. All right, Royce, what say you? You're the last one on market, up, down, flat.
I think, hold on to your hats, gentlemen. Remember what I said? I'm not sure if you guys remember what I said November 22nd. So banks changing some of their regulations on November 22nd for SWIFT handling. We've seen
make it easier.
Make it easier to claw back money with all of these cryptocurrencies and digital assets coming in that can basically get back fraudulent wires and being added to the rails of the banking system, there is a good chance we're going to see a nice jump in all the cryptos. And basically, what they say, buy low, right? So they never tell you where low is. Well, we're going to say right here, this is low. This is the bottom of the crypto pullback. I think between now and February, you'll be surprised the numbers you'll see.
All right. That's crypto. So same with equities?
You didn't ask about equities. I'm not talking about equities.
It's very crypto.
All right.
That'll cost you extra.
Yeah.
You got to tune into the Sunday seminar for that.
Pay the man.
Yeah,
Pay the man.
for the Sunday seminar.
Yeah.
And learn sign
Make
language.
sure, make sure you have the audio on this time.
Yeah, right.
Ouch. All right, let's move on to.
So from that, just for your own records, I'm buying a new laptop because I think the board's actually going bad on this one, and all the audio, all the video problems I've been having with it the last couple of months. I'm like, okay, enough of this. We just got to do something different.
Nice. All right, so
You
let's
should
move
just
on
put,
to
an NVIDIA server under your desk and just plug it into your monitor.
I'm going to stand up my Ethereum miner, and we're going to go from there.
There you go.
beta test. There's what I was. That's where I was going. Go ahead while you're doing the capital improvements. Let's go ahead and move to the headlines.
Maybe one day I'll be able to touch the money that's been sitting there.
That's right.
We're not going to talk about that on air.
Nope. It's ours, but you can't have it.
Yep. I felt
window shopping.
From my soul.
Yeah. All right. So fun headlines. Let's go ahead. It's Michael Burry. You know, when you say hedge fund, I never get upset when a hedge fund closes. So go ahead, Daniel. Tell us what happened there.
So I wanted to read all these headlines because I feel like when you put them together, it's kind of like a funny mix of news.
Yeah, it is.
So you have like some kind of like positive things and then some like negative things and then some confusing things. So the first one is Michael Burry closes his hedge fund, which I find ironic because I think it was a week or two ago, we talked about those like short positions he had on, right? Which would have made money, but at the same time, he's closing his hedge fund. So I just find it kind of ironic that the guy who's, famous for being bearish is, finally correct on his trades and then closes his fund. And I was like,
he's trying to leave on a high note. He's like, and I did it again.
Well, yeah, but he cashed out right before they would have hit.
Or without having to report on what he's reporting right before they hit.
That is
if you close your hedge fund, you no longer have to report what you're trading.
Well, one of the things that I had heard people talk about is that it's like unclear if the positions he had on are still open until they're closed, or if you close your hedge fund, if they immediately have to close. And so it's kind of unclear. But I just thought it was kind of funny. It was like, oh, you're finally correct on all of your shorts and then you're closing your fund. So I thought that one was funny. Then JP Morgan, Royce will like this one, is launching their own coin. I'm sure it is an internal XRP competitor for, transfers and whatnot. And which is funny because Jamie Dimon has always been the most bearish bank CEO when it comes to crypto. But behind the scenes, they've always been one of the banks that is by far the most ahead when it comes to having a crypto trading desk and being able to provide it to consumers. The government reopened, but the market's traded down on the news, which is never a good thing. Valuations for publicly listed private equity companies are down 13%, which is, typically a risk-off move. So it's people, when you think about investing in private equity, it's a bit riskier, but the real issue is that your money is locked up for the term of the fund, somewhere around 7 to 10 years. And so I see that as, in the most public way you can, people are kind of like saying like, I don't want my money locked up in that because I don't know what the future holds anymore, which, you know, based on the last couple months is fair the way things have gone. And, you know, when I just kind of put all of this news together, it does feel bearish, right? I still stand by my statement of earlier is I don't think we get more than just a basic correction. But it is interesting.
How is that bearish? It's 5%.
Well, no, I said it could be a 10% total, and then it's back it up into the right for there.
Yeah.
God forbid the market corrects twice in 1 year. You know.
What?
Yeah, because normally it does way more than that. But
I would like to draw your attention to 2000. I think it was 15 and 16 August, and then the first month or 2 months of 16, 4-month period. Boom, boom, and then look at everything that followed that. 2 dips, and then 4-year rally.
Let's be honest. I was a freshman in college, so I was not looking at this. I do not recall that time.
I'm not. Okay.
You're not going to sing "We Were Merely Freshmen," Royce?
No.
Oh, I thought that may have popped in your head.
No, that was not what popped into my head. Like,
all right, the man with the coin.
Royce, educate me. Like during that time period, you know, did it just kind of like, was it a small correction that just muddled down and kind of built some like consolidation before taking off? Like what happened there?
August 2015, there was a flash crash around, I think, the 16th or 17th of August. And then basically it bounced. I mean, it bounced that same day. There was like the S&P 500 spanned about 1,700 points in a single day from its lowest to where it picked itself up to. Then everyone's like, okay, it's over. That was a flash crash. Great, nothing to it. As soon as it was January of 16, literally from January, I think, 2nd or 4th or whatever it was, all the way until March 16th of 2016, it was ugly. I mean, god-awful ugly. But then after that, after March 16th, everything was literally rising until we got to COVID-19 crash.
Cycles, which Daniel.
Two dips in 1 year is sometimes a very, very good thing.
Yeah. Oh, Daniel put that in his last two blogs.
Royce's memory of that is like perfect. I'm like looking at the chart.
Not saying I was training my algorithm, but yeah,
like literally to the day, like perfect on what he said.
Wow. Those were impactful days for him.
And beware the Ides of March.
I will say just the one thing, because I looked at this as well yesterday, is because I think Josh and I were talking about, is that this is a bit more of like out of the blue correction, in the sense that even for April, we were really trading sideways for 2-3 months. And, you know, I'm looking back at this chart and, 2015. And in there as well, we were really trading sideways for like 3-4 months before it corrected. So I do think that, just my opinion, not necessarily like trying to contradict Royce, is that this might like recover quicker, because it's just it seems to be like have a more like quick little sell-off pattern than it's like the market has been on its like heels, kind of preparing for this, of kind of what we see with a lot of these other, we'll call it bigger corrections.
Cool. The only thing you missed out of that whole thing was pennies being discontinued. And we'll move on because it's really a non-event. It's historic, but we'll move on.
Everything is going to get rounded up now, Darin. That's inflation.
That's right. Josh, anything before we move on?
Oh, I mean, I just a little thing about Michael Burry. I just think it's funny that he kind of seems to have this like, I mean, obviously he has a cult following because he did, he's a big short guy, and he did correctly call the 2008 housing crisis. And he meant to go back and look at historically what he has predicted, go back, look at articles he's published, like tweets he's thrown out there, like, public comments he's made, and you add it all up, he is wrong over 70% of the time.
Yeah.
He hit one
home run. He is right a couple of times.
But does he make money? Like, do you know? Like, a genuine question.
I mean, he just closed his hedge fund, so I'm going to guess probably not. And I mean, the only other one that you can definitively say that he was correct about, he's had a couple that he's sprinkled in that, maybe he kind of called, okay, we're going to have a downturn in like 2023. And yeah, we had a little bit of a downturn. I think he called something in, 2019 or maybe even 2015 when Royce is talking about. And so he's hit, he has made a couple of correct calls, but overall his track record is piss poor. And if you're going to give him credit for this AI bubble, then you got to give us credit for calling it too, because we've been saying the same thing for like almost 6 to 8 months now. So, I mean, he's not any smarter than we are.
Yep. Eventually you're right.
He's snarkier.
Yeah. I mean, he might have a bigger following, but I think we're more accurate.
Yep. All right. Let's introduce something that's kind of
on you, Josh. I got this. We got this.
I appreciate it.
I say Josh is like right every week.
I mean, it's your bank, it's your system. I'm just using it.
Like Morgan Wells, 2027.
Yes, let's do it.
That sounds like a law firm.
Mm-hmm.
Morgan Wells and Hopwood. There you go.
There you go. I obviously have been left out, but that's all right.
Oh yeah, and the ape.
Don't worry, Darin. We need an assistant.
Yeah, no, thanks. I'll find the red stapler in the basement. All right, let's move on. By the way, to a new concept that it wasn't Trump, it was Pulte, I believe, is the one that came up with the 50-year mortgage. I'm sure there's nothing that bad that could happen with that with property values, but go ahead, Daniel, and tell us what that is, the concept.
Yeah, so the idea was brought up of having the 50-year mortgage. And the idea behind it is that, you have this longer term mortgage so that it should help lower payments and increase home buying, because if you make the payments lower, more people can, afford to buy a home because lowers the payments, right? From the math I saw that was done, I don't know how good the math was. It only lowered the payment by like $200 a month, which is like pretty negligible overall. And some of the concerns with this is that having a longer loan like that is typically, viewed as a bank for underwriting as riskier. So they actually increase the rate of the loan, and it makes it more expensive. Now, in defense of that is that, when they introduced the 30-year mortgage, everybody was up in arms about the same thing, right? So eventually the market did price itself, I would assume correctly, right? I'm not like a loan mortgage expert. I don't know exactly. And the chief economist at Redfin, so one of those, home buying sites, warned that having an increase of home buyers with a 50-year mortgage would actually just further drive up housing prices, right? So a lot of the kind of summary of it is that the speculation of the 50-year mortgage, of what they want to do by getting more people to buy homes and, ideally making it cheaper, wouldn't actually solve any of that. It would make it all more expensive, instead of, doing the thing that is unarguably making homes cheaper, which would be having more inventory. But before I get over my skis, because I don't even own a home, I know Josh works or used to work in real estate. I don't know what you really do, besides, look cool behind your little background. Tell me more about this, because, this is just not my domain. I don't act like I think it's a good idea on the surface, but like when you actually implement it in theory, right? Because we don't have one, other countries do have it. Does it actually work? Does it provide value, or are we just kind of like shooting ourselves in the foot ultimately?
Well, I mean, weirdly enough, this is not as unprecedented as it seems. Like there are other countries, like the UK's done it, Iceland's done it, Japan's done it. I think Spain, a handful of other places have actually are already implementing like 40-year mortgages, or at least allowing it to be an option. But what they're really doing, and I mean, I guess more of a relatable situation is like, let's say, you're shopping for a car. Then you if you go into a dealership, the first thing that they're going to ask you is, how much what do you want your monthly payment to be? They don't necessarily care what the price of the car is. They want to know what you can afford per month, because what they're going to do is they're going to come in and they're just going to stretch that monthly payment into, 72 to 90 months. So you're paying this car off for 5 or 6 years. What they don't factor in, or what, and that as a barrier for entry is great, because you come in all of a sudden, hey, look, I can, on paper, monthly payment, I can afford this particular car. I'm only going to have to pay, like what, $500 or $600 for like a $50,000 car, because you're stretching the payment over, 90 months. And it's a tactic that people have used before. But then if you start actually running the numbers, and the other things that they've introduced in the housing market are things like they've removed the credit minimums for people to actually apply for mortgages. They're starting to do more of,
just change that. Yeah.
Yeah. They're starting to do more of like the 0 down mortgages. So to the point of it will drive up prices. Yes, that is almost certainly what's going to happen, because you've got now another, I'd say 15% of the population that can afford houses that they afford houses in general, and afford houses that they would not normally be able to afford. So it is going to bring in buyers from the sidelines, and it is going to at least level off prices, if not raise them. The problem is that the cost of the house in total, most of these 50-year mortgages are going to be upside down at some point, because you're paying essentially if you look at the amortization schedule, which is how much you're paying in principal versus interest over the span of 50 years, all of the loans are front loaded interest first. So when you're paying like the first year of your mortgage, every single payment you make is almost 90% interest. So it is throwaway money. Like if you look at the difference between like renting versus buying, they always talk to you about the throwaway money. Like how much are you going to like if you're going to stay there for 5 to 10 years or less than 5 years, it's actually cheaper to rent, because you have so much upfront cost and you pay so much in interest for those first 5 to 10 years that unless you're going to stay there for an extended period of time, you might as well just rent. So for example, let's say a $500,000 house, let's do 6% interest, which is kind of, the average right now. I don't know if they're going to raise it, like you said, with the longer term ones, but they might. It's something that happens. Let's say you get a 30-year mortgage, you're going to pay roughly $3,000 a month. You're going to pay $500,000 house, you're going to pay $580,000 in interest. So the total cost of that home over 30 years is now $1.08 million on 6 years. And that's assuming that you don't make any additional payments. You're not paying over the top, which I would always recommend that you pay more than what you're actually, your monthly minimum is for your house, because that goes directly to principal. But if you do 50-year mortgage, you're going to pay $2,600 a month. So seems better. Realistically, it's only $400 better. $400 a month is not a massive number, but it does change the amount that people can afford, because you always do that. What can I afford based on my monthly take home? And you want to do less than like 30 or 40% of your total monthly take home. And even that number is high. So it does bring in people that don't make as much. They are now able to afford a house. But if on a 50-year mortgage, you're paying $2,600 a month, yes, that's lower. What you're going to end up paying purely in interest is $1.05 million. So you are now like your home, the actual cost of your home is now $1.55 million. When in reality, you're on paper, you're looking at, okay, this is a $500,000 house. So you have to really think about how much you are going, like, A, how long are you going to be there? Because you're pretty much going to have to die in that house in order for you to not be upside down, because you pay the first probably 20 to 25 years, you're paying majority more in interest than you are on principal. So unless the housing continues to appreciate like it did the last 3 or 4 years, you're going to be underwater in that house because of how much you owe because of how much you have not paid in principal that you're still going to owe on that house. And so it's just like, yes, I do think that there is some merit to it. I do think that if you could it'll bring in some people, and if they're smart about it, they're going to refinance 5 years down the road. They may have screwed themselves for the first couple of years, thrown away some interest that they paid. But overall, it's a really bad idea. I mean, if you look at the other places that have done it, other countries that have rolled it out, it's been widely, I don't want to say shunned. It's just not everybody kind of knows if you do the 40-year, you're essentially buying that house to die there. You know, that is.
Mortgage literally means debt pledge in French, right?
Yeah.
Yep.
So it's not, and it wasn't until 1929, almost 100 years ago, that the structure that exists today, it was no, like, a mortgage literally was supposed to only be meant for 5 to 7 years. You would have to put up almost half the money up front, and then basically you would borrow against it and then use it like a bank account, and basically use that and basically have your money pay into it. So within a 5 to 7 year period, you can get it completely paid off, because a HELOC basically is interest only. So if you use that line like your bank account, anything that you didn't spend would automatically fight the interest of the daily interest. And then basically every time it's back to full use, you deploy that against the principal. And once again, 3 to 5 years, 7 years, it's paid off. So instead of going the right way and getting people where they can actually pay off their mortgages, they're going the complete wrong direction right now. 40, 50 years, that's insane.
And I want to go back. I say that this is something that's been rolled out before, but I do want to put a caveat there. These 40 and 50-year mortgages that have been introduced before were introduced in like the late 90s, early 2000s. When the global financial crisis happened, apparently most of the countries other than the US learned their lesson and stopped and went much tighter with the lending and much tighter with the requirements, much tighter with what you had to bring to the table for you to actually qualify for a mortgage. So yes, it did keep buyers out, but it brought property prices down, and it saved this, from the housing bubble from increasing, which I think is what's this 50-year mortgage, if it does in fact roll out, which is still not a guarantee, is going to just push that bubble further into the stratosphere.
Yeah, because more foreclosures, more people not accruing. Yeah.
And we're even to that point, we're already seeing a record number of foreclosures. Like the people that have filed for foreclosures has hit, I think they said an all-time high in the past 2 months.
Oh, wow. Yeah.
Cars too.
Yeah,
cars too. I mean, it's the thing. It's a cars and homes.
Don't worry. Nvidia's up 5% after hours. It's gonna be okay.
Yeah.
Thanks, Daniel. Well, I mean, this could be a push for the banks to try to own all the homes. I mean, who knows? Well, I mean, all the homes and all the cars.
Well, if at 50 years you don't own it, it looks to me as if it's like a push towards socialism.
Yeah, yep, that's what I'm getting at.
I mean, it is going to end up.
We don't see that rising.
Because I'm like, okay, because in Dubai, none of the people own the land. They all rent to be there. And basically, if you push it so far where you never actually get the full ownership where you're not paying, that's the ideal scenario.
And you hear Musk talking about universal income again.
Yeah,
so we won't go off into that. Yeah.
Have a little sample. It's just a little sample.
Yep.
Mhm.
So we'll see how New York does with their leader now, New York City. So let's go ahead to government shutdown. It is now open for business. We talked about it a little bit in the beginning, and of course we're going to get the institutional answer from Daniel as he puts out this historically blah blah blah. So go ahead. What's going to happen now since we've had this government shutdown, which is the longest, which means it's unprecedented, which means there is no history. But go ahead and tell us what's going to happen.
It often rhymes.
Wow, Darin, hide your tinfoil hat, huh? Jeez. Sorry, I read the news. All right, so first thing I want to point out is that I do think part of this little correction we're seeing in the market is the fact that we did have the longest, government shutdown in history, and that we did kind of barely come back, even when we did come back, for the bill to pass for the funding. And I think part of the correction is the uncertainty that the market has of we have only kicked the can down the road, 2.5 months. So in 2.5 months, we now have to deal with all of this again. And on top of all the other things that are going on in the market and the uncertainty. So I think that is, in part is the market, kind of saying of like, we are uncertain of what the future holds and where things are going. And somewhat surprisingly, you are seeing the dollar rise of like, all right, well, we kind of need dollars again because it's a flight to safety, right? Even in times of the US government being uncertain, which I still think shows, how, kind of powerful and stable the US is, all things considered, compared to other places, right? So I'll let Royce talk about the dollar later because, he's been saying it
fine. Everything's fine.
Yeah,
I remember him saying 116.
If you listen to Royce's webinars, currently his predictions are playing out. That's what I'll say. So historically, which according to Darin's irrelevant, the S&P has risen an average of 11.5% one full year after the government shutdown. And the index returned 3.3% over the 3 months following the shutdown and gained 7.8% in the 6 months afterwards. So pretty much it went 3 months after, it went 3%, 6 months, it went almost 8%, and a year after, it went 11.5%. Now, if people remember earlier in our podcast, we talked about maybe things are rockier now, but Royce pointed out that it would be up and to the right after. So maybe this time, Darin, you will be right on the short term. So maybe you factor that into your after the bell bet. But in the long term, we are probably back up and to the right.
And in other words, we're back, baby. We're back.
Whoa.
Let's see how long we shut down in January, okay? If you have another, it doesn't even have to be long in this one, but another long shutdown, I do think that'd be pretty bearish, right? Because of dysfunction once is bad. Dysfunction twice, I think will be a big shame on you moment for the U.S. and uncertainty in the markets, right? Because I do kind of think, we read all these headlines, the market is asking for just give us one good reason, right? And if it's not going to be a big drop in the Mag 7, which is kind of carrying the market, they'll take, extreme government uncertainty. So, that's the facts and my opinion on the matter. Darin, tell me how I'm wrong and how the world's about to melt.
No, it's we still have the whole tariff being legal thing that has to play out too, but and then what that will mean, but honestly,
my hot take is that's a nothing burger.
Exactly, and then if you hear the analysts now, which means that this is not going to happen, whatever they say, because they're trying to throw everybody off. But a lot of the CNBC analysts now are moving to, yeah, well, now 2026 is now going to be a flat year. We'll be lucky if we get 3%, blah, blah, blah. So you know that's not what's going to happen. So it's hard to.
What happens if it is?
Well, then they'll finally be telling the truth, I guess. But I mean,
I think we have
to make a side bet.
I think we have to light Darin on fire if they are right and he is wrong.
And then we're going to do the usual. Every year we have the Santa Claus rally, yawn, which happens, and then you get all the tax things that happen for companies to get the most benefit out of that. So it's going to be an interesting thing, but I think I've heard people say January is going to be a rough month, but I mean, we'll see. I don't really have an opinion on the full year, but I do still think we got another 5% to go down.
It's too close to 1 year anniversary of the inauguration. I think they're going to try to pump as much as they can get out of it until January the 20th. Let's go.
So the last week of January might be rough. Okay.
Absolutely. Approval ratings up. Hey, come on.
Yep, there you go.
Aren't approval ratings at an all-time low? I feel like this is a fact Josh would know.
Yeah. That's why I'm saying what I'm saying. It's like, how do you fix that? Give them what they want.
Yeah, it also depends on. Need what?
Another steady check. Let them get roll some options on Robinhood or Polymarket now, and approval ratings will go up.
Well, just remember, we're depending on surveys, so you know what I think about those. Let's head on to the Mag 7 sell-off, which is what has been happening. Google actually has pumped it up though because of their ER, which was good, and plus they rolled out Gemini 3, I think it is, which is supposed to be a developer's dream, and it's supposed to be like the best yet. And then you have these other companies that are trying to create their own browsers, etc. So I don't know. It's crazy. I don't know where it seems like competition should be a good thing, but then it also can be a margin killer for those that aren't the top three. So we'll have to see. So what you got about Mag 7, Daniel?
Yeah, so one of the interesting things that I saw is that there was selling and buying at the same time in these names, right? So you had Peter Thiel's macro fund sell the entirety of their NVIDIA stake, which, it's not like it's a huge market mover, but it was interesting that they sold all of it, which was 40% of the portfolio, right? So it's a pretty big stake in their portfolio. And Peter Thiel, I guarantee you, he's not employing dummies. SoftBank sold their entire position in NVIDIA last month. And I don't want to read too much into this. Like there's some market tell that NVIDIA is going to crash. Like I think these guys are just up huge and they see this as like a good time to take profits, right? Like they're probably up like
lock it in.
Lock it in, right? They're like, okay, the earnings are slowing a bit for NVIDIA. They're still making money, right? Their multiple is actually like much better than it was a year ago. And they're like, okay, like we got the main part of the drive, so it might slow down now. But it was funny to see these sells, and on top of Buffett's exiting act is that Berkshire bought 4.3 billion of Google to make it one of their now top 10 positions, right? And I think people are getting construed. I don't think Buffett bought that position and like walked out, right? I do think it was his new team, probably somewhat under his guidance, and they're kind of, we'll say, modernizing the investment. But I do think that it is a good tell for Google, right? They are, I believe, the cheapest Mag 7 name from a multiple perspective. The average multiple on a Mag 7 name is 35 times earnings. They're at 25. And they do, of a lot of the AI players, have the most room kind of for improvement. And just because of their market base, have a pretty easy chance of, if they become a clear winner in AI tech, to implement it everywhere. And even have people like us who maybe use ChatGPT, like myself, to pretty easily switch to Google because it's already integrated in a lot of the stuff we use. That being said, when you look at a lot of these names, they are starting to sell off, especially if you look at someone like Meta, who I forget how much they're down from their high, but it's pretty significant. Let me look real quick. About 25% from their high. And a lot of this has to do with, an excessive increase in CapEx without any clear return on that investment. And I think this is a sign that investors are saying, okay, we see you spending on AI, but when is the return going to come? Because, we saw Sam Altman freak out. Everyone knows the numbers that, for OpenAI to meet their CapEx commitments to these hyperscalers, they need to make like $1 trillion in the next 5 years. So, the numbers are getting, pretty big. And I think the market is saying like, okay, let's reel it in a little. We've had a big growth phase, but let's see a little bit of plausible return on the money. And I don't know if you guys remembered, maybe a month ago, I had talked about, what would be something that could actually see a correction in this. And, if you look at one of the things that led to the tech bubble bursting was that leverage was start to brought in to the investment in the sector on things that weren't making money. And to be fair, I think AI is less of a bubble than the internet because there is money to be made. A lot of these companies do make money, but Oracle, if you look at them since they had their big pop, they've sold off 30% from their high because the investors are not sure about their ability to actually make good on their commitments to OpenAI. They've sold or done a bond issuance of $18 billion, and as well as they're planning one of $34 billion. So they're kind of the first big player to come in and start using some kind of leverage. I don't want to make it, I'm sure these bonds are pretty well underwritten, but really kind of bringing leverage into the chat for, of we're going to grow, but we don't have the free cash flow to do it. So we're going to go out and borrow the money. And, I don't think Oracle's a canary in the coal mine of they're just not a dominant hyperscaler AI player like currently. But if you start to see a lot of these other companies bring in leverage, I think the, Mag 7 picture could get a bit scarier.
Yeah, it could be just simple as moving all their money from chips to the data centers. And I think that could be a lot of what these guys are doing, just selling at the top with the chips. And now they're going to move into whatever the data center stocks are. We'll have to see how that plays out. I guess we can go ahead and move on to, you guys got anything before we move on? Try to close it out here. No,
just real quick. I just kind of thought it was interesting with this whole sell-off. We had talked about for months and months and months that we were waiting on this like singular event to happen that was going to trigger this sell-off. It was going to be like scene files get released finally, and we get, half the government gets locked in jail, or we get, or NVIDIA.
It did just happen.
Maybe. Apparently we got 30 days. We got 30 days, maybe. We'll see what happens. Or we were just looking at something, and it's kind of what made it so hard to figure out like what was actually happening and to read the tea leaves, is because we weren't actually seeing any kind of like one big headline. Because that's when I was asking you guys while I was out of town, I was like, what is going on? Like, why are we getting all of these? It seemed like everything sold off at once, but there wasn't really. It's not like there was a grabby headline that you could point to. It was just like you kind of saw a bunch of like portfolio de-risking, and I guess people with the government not releasing numbers, people stopped relying on government numbers, and I guess started forming their own and realized, oh yeah, it's as bad as we keep saying it is. And all the tech and AI overvalue and the little circle jerk that keeps happening there. It's just it never seemed like there was one big thing. It was just kind of like the diamond hands finally let go.
I know.
Yep. And again, there still could be some more things that happen, events between now and the end of December, because we do have Trump as our president and a world that is just acting really crazy right now. So
don't forget the AI Atlas, whatever thing.
Oh yeah, it turned a half circle and went. I don't know what it did. Something crazy. I don't know. That was another distraction, I think. But we'll have to see where that goes. Yeah. But let's go ahead and close this sucker out. We've got the most important thing here, of course, is that we have this weekly competition that we do, and I finally won.
I like how it's important this week.
I'm done. I gotta get out of here.
It's I tried my celebrations tried to get derailed because we don't have a chart, but I'm gonna still pull up the actual. No, that's let's go here to scoreboard. There we go.
I half-assed made you a chart there. Hang on.
So on the 10, there should be another mark there by me. So I hit 2. So I'm tied for second now. Yay! And then Daniel will have to pull up and win one.
Dang. That's the way you want to play it? All right.
But Royce, you had, I think you, that was a quick mention. We can move on. You had a chart you wanted to, I'm serious. I'm being good here. You had a chart that you wanted to share. I think you were going to look at Tesla. Is that right?
Nah.
Nope.
No one should know too much about their own future.
Okay. That's cool. No, that's fine. That's fine. We can move on it because I know you got some appointments and stuff to do. But I will tell you that the stock that was picked by me is Nike, because we're about to head into the Christmas season here of buying, and Nike seems to be pretty low right now and trying to get up off the bottom. So let's see what you think, Royce.
I think Darin's a boomer and should buy On Running instead and get with the times.
That's for all you millennials to buy. But
I think
the hedge funds.
I don't care for those shoes, but I just want to make money.
Yeah, when am I
the
getting
hedge
my money?
funds actually love On.
It doesn't look good. This doesn't look good. I'm gonna bring up the dashboard. Gonna bring up 3D. No, this doesn't look good. This doesn't look good.
Wait, Darin, is this your bet stock?
Yeah. Yep.
Okay. May the odds be ever in your favor, sir.
Well, the biggest thing is it a big enough channel for us to do?
I'm gonna say this. I'm gonna turn on my trend top and trend bottom. Let me know what the short-term time frame says is possible. It's close to the bottom of a short-term time trend, but it looks like it's going to top out. It won't be able to get over $66.51 according to that chart. But given that the range across all these time frames is about 60 to 67-ish. Yeah. Try your luck. 60 to let's do the full range. 60 to 70. So that way we'll say everybody get 250. Enjoy.
250. All right. And my strategy, of course, is going to let's start that. That'd be 60 to 62.50. I'll do that. I'll just write it down while you guys are doing your thing. But go ahead, Josh. This is my strategy last time. Is let him go first, and I will go second.
I want 65 to 67.50.
All right. 67.50.
I had my number was 65.50.
Huh. Okay. Yeah, because we're talking about just a week here. You know what? I'll take below that then, so that we'll have the bottom covered.
We're gonna let them bookend it again.
How do you get the bottom covered if it goes from 60?
He says 65. Oh, yeah, so your third level.
You're not
mad.
You're mad good.
Yeah.
Middle covered.
Who let the apes in? Not who let the dogs out, who let the apes in.
Yeah. Well, I had originally, I wrote the top end first of the 60 to 62.50 range. So I'm gonna dang. Well, I guess we'll just take the middle then and let them do the extremes then. So I'm gonna take the 62.50.
Daniel.
I'll take the under, I guess.
Guess I'll take the over then. That's right.
Josh took what I wanted, so shocker.
You take the top or the bottom?
It's the top. Daniel is. I mean the bottom.
Okay.
And Royce is the top. So and based on the way they responded, I think we did good, Josh. High five through the.
Yeah, I don't think either of them wanted that. So yeah.
That means we're probably going to lose next week. All right.
Did we finally foil Royce's plan?
Oh, actually, yes. Yes, you did. yes, you did.
It's been a
I
long
didn't hear
time.
aha.
What happens when Darin goes
pick the numbers? Yeah, I expected Darin to pick the absolute bottom of the channel, but because his math was off.
It wasn't my math. It was my the selection of the channels. I started at 6250. Anyway, I get a pass this week anyway for everything. That's why I won. All right, let's reconvene next Wednesday, same time, same place here at Arbitrage after the bell. Everybody have a great week and weekend. Bye.